Hi guys, welcome to the second video on Simply Invest. I'm YJ and today, I am sharing with you a simple way to analyze a stock in less than 40 minutes. We will be looking at what I call 7F. These are the 7 factors I look at and analyze when deciding about a stock. At the end of this video, you should be able to analyze the stock by yourself using the 7F and make your own decision on whether to buy, sell or hold a stock. This is the second part of the stock investment tutorial video. If you have not seen the first part, I suggest you go watch the first part before continuing to watch this video. Moving on to the third factor where we left off in the last video, we will now be looking at price to free cash flow ratio. Free cash flow is the adjusted earnings after taking out financing interest cost, non-cash income and expense. In simpler terms, free cash flow is the money a company has left over after paying its operating expenses and capital expenditures. Capital expenditure is expenses used to maintain or buy new property, plant and equipment for the purpose of ongoing operation or expansion of company's operations. The reason why we look at free cash flow is because it is generally more accurate than earnings. Free cash flow is more difficult to manipulate as compared to earnings, because there might be non-cash profit in the earnings. Take for example, for the company Amazon, there is a non-cash $11.8 billion pre-tax revaluation gain recorded in earnings due to the company's stake in the truckmaker Rivian Automotive, RIVN, for financial year ended 2021. This revaluation gain might be artificially inflating its revenue, as Amazon has no intention to sell their stake in Rivian and realize the gain. Price to free cash flow is similar to P/E ratio in the way that it tells you how many years you are estimated to get back your investment, if the company were to give you 100% of their free cash flow back in cash or dividend. Free cash flow is important to the company as the company can use it to pay dividend, make new acquisition for expansion, reinvest into company, pay down interest on loan and other liabilities. To calculate the price to free cash flow, we can take the market cap divided by free cash flow. The market cap of a stock can be easily found on Yahoo Finance. Free cash flow is calculated by taking cash generated by operations minus capital expenditure. Or you can directly extract the free cash flow from Yahoo Finance without calculation, which is what I usually do. For free cash flow, I will usually take the average free cash flow of the last 3 years. The financials from the past 3 years more accurately depict the current financial situation the company is in. Of course, you can calculate the average but taking more years into consideration, but in my opinion taking the free cash flow from too long ago might not be reflective of the current financial situation the company is in. 4 years or more is a long time, and the company may have changed a lot since then. If you noticed from the illustration, the operating and free cash flow of the company fluctuates greatly. To give you some accounting knowledge, the increase in account receivables will reduce cash flow. And the increase of inventory will also reduce cash flow. This is due to the fact that when accounts receivables decrease, it means that vendors have made payment and the company cash flow will increase. Vice versa. The increase of accounts receivable will decrease free cash flow. So you may be curious why the free cash flow and company operating cash flow increased so much from year 2018 to 2019. It is due to the increase in receivables in year 2018. The company then manages to collect the outstanding receivables in 2019. If the concept is too complicated, all you have to do is take the average cash flow of 3 years or more so that collection of debt will not affect the free cash flow too much. Back to the calculation of price to free cash flow, taking the market cap divided by free cash flow, we will get a price to free cash flow of 5.2. I have to convert the free cash flow to HKD before computation of price to free cash flow as the market cap is denominated in Hong Kong dollars. A price to free cash flow of 5.2 means that the investor is able to get back their investments in 5.2 years' time. This is with the assumption that the company free cash flow does not increase or decrease in the future, and the company gives 100% of its free cash flow back to their shareholders every year. Moving on to the next factor, current assets and liabilities. We need to look at the current asset and liabilities to ensure that the company that we are investing in does not have any problem meeting its financial obligation within 1 year. In other words, the company will be able to pay off its liabilities that is due within a year. In the financial statement, current asset refers to liquid asset that can be or expected to be used within a year. And current liabilities are liabilities that is expected to be due and be settled within a year. To do this, we will be looking at the balance sheet readily available on Yahoo Finance. As long as the current asset is more than the current liabilities, it should be fine as these current assets are assumed to be easily converted to cash. In most of my example today, I am extracting most of the data from Yahoo Finance as I want to show you that you can also do the same to evaluate a stock, without any special applications. The fifth factor that we will be looking at is non-current asset and non-current liability. When you invest in a company, you are investing in the company's future. You will want to ensure the company has enough funds to meet its future financial obligation. Unless, your investment objectives is not long-term investment. In the balance sheet, non-current assets refers to long-term investments that are not expected to be sold and turned into cash within a year. And non-current liabilities refers to any debts or other financial obligations that can be paid after a year. To look at the non-current assets and liabilities, I will look at the actual financial statement, as Yahoo Finance does not provide the full breakdown of it. Looking at the financial statement will also provide more in-depth information about the company non-current asset and liabilities. The financial statement of a company can be found in the stock exchange or the company website under Investor Relations. Depending on the stock exchange the company is listed in, the company will be required to report its financial position quarterly, semi-annually or annually. In this example I will be extracting the balance sheet as at 30th of June year 2021. Generally, I would assume that other than receivables in non-current asset, the company will not be selling any of the other non-current asset to raise cash. As most of the non-current assets are assets that the company requires to carry on its business. In this illustration, there seems to be no receivables in the non-current asset section. Therefore, I will assume that the company do not have any non-current asset to cover and offset its non-current liabilities. Moving on to the non-current liabilities section on the right of the illustration, I will assume that the company will need to pay of all the liabilities, which amounts to 18,837 million RMB, in 2 years' time. I guess you would want to ask me why I assume 2 years as the payback period for the liabilities. As you can see, beside each breakdown of the non-current liabilities, most of them have a note number attached to them. You can refer to the respective note in the financial statement to find out more about the breakdown. So what I did was look at the biggest liability that the company has, which is interest-bearing bank and other borrowings. The related note number is 20. From note 20 of the financial statement, I found out the average payback period is around 2 to 3 years. Therefore, I will use 2 years payback as a prudent estimate for the average of all non-current liabilities. What I will need to find out now is the dividend amount that the company distributes annually. You can see the dividend from the dividend announcement in the financial statement. The dividend in the cash flow statement shows the dividend paid last year, therefore it is not the most updated. You will also notice from the cash flow statement if there are any dividend paid to minority shareholders. In other words, shares which are not listed in the stock market and are owned privately by other entity. By looking at the cash flow statement, I found out that besides from the stock listed in the stock market, there is another entity that owns the company. The other entity owns around 50% of the company, and the remaining 50% of the stock is listed in the stock market. With this information, I will be able to find out the dividend. From the financial statement I estimate that the dividend that the company give out every year is 2,153 million RMB multiplied by 2. This gives me 4,306 million RMB. The reason why I multiply the amount by 2 is because the company will need to pay the same amount of dividend to the other entity that have a 50% interest in the company. With this I can calculate the free cash flow after dividend to be 4,208 million RMB. I will then take the total non-current liabilities and divide it by the free cash flow after dividend. This will give me 4.47. What this number means is that the company is estimated to be able to repay all its long-term liabilities in 4.47 years' time. Given that, the company uses all its free cash flow after dividend to repay its debt. Since I said previously that I estimated the payback period for the long-term liabilities to be 2 years, you would ask me what would happen if the company cannot pay back all the debt in time. The company needs around 4.47 years instead of 2 years to pay back its debt. What the company can do now is to raise cash via bonds, new share issuances or lend more money. In my opinion, it is normal for companies to roll over debt as long as debt is not overly excessive. Different people have different opinion on how much debt is considered over excessive. To gauge if the debt is excessive, what I suggest you to do is write a short story about all the information about the stock. After you read through the short story, you will then ask yourself, would you buy this stock? I will now give you an example on how to write a story, based on the assumptions estimated in the video. Based on the information and assumption provided in part 1 of the tutorial, my expected gain on stock price is 136% in 5 years' time, if the company trade at APE 12 in 5 years' time and grow its earnings at a rate of 5% per annum. The company will be able to pay back all its debt in 5 years' time. The company has a price to free cash flow of 5.2, but I will need to multiply it by 2. The free cash flow need to be split between the public shareholder and the minority interest holding another 50% of the company shares. Therefore, after 5 years, I will be able to get a dividend of 9.6% yearly. How I get 9.6% is by taking 1 divided by 10.4. This is with the assumption that the company does not reinvest its free cash flow, the company will give all the cash flow to its shareholders, and the company free cash flow does not improve or decline over time. The end. The story has ended. The question you must now ask yourself is whether you will buy the stock taking into consideration the gain or loss on stock price and the potential dividend you can get after the company paid off its debt. You will also have to ask yourself if the number of years that the company takes to repay its debt is too long. This is generally how I gauge if the company has excessive debt. If you are interested in this stock, you can join my Patreon at the link in the video description below. We are now down to our last two factor. Return on invested capital tell you how efficient the company's management uses equity and liability to generate income. The formula of return on invested capital is invested capital divided by net income after tax. You do not have to memorize the formula of invested capital as it is readily available on Yahoo Finance under the balance sheet section. You can calculate the return on invested capital by directly extracting the amount of invested capital and net income from Yahoo Finance. Or you can also Google the return on invested capital of a specific company if you don't want to calculate it yourself. I usually just Google the ROIC of a company to avoid the hassle of calculation. Generally, a return of invested capital of more than 9% is considered as good. Now, I will move on to the last factor. Issuance of shares. Why do you need to consider issuance of new shares, you would like to ask? Is it good or bad for investor? My answer to you would be, issuance of new shares is generally bad for investor. Take for example you own 25% of a company currently. The company then proceeds to issue an extra 100% new shares. You will now own only 12.5% of the company. Meaning that your earnings has been diluted from 25% of the company's total earnings to only 12.5% of the company's total earnings. However, there are times where it might be good for you as shareholder. These are rare cases where the stock is trading at very high valuation and the company is able to issue new shares at those high valuation to raise cash. As mentioned previously, a company can issue bonds, shares and take on loans to raise cash. When a company's stock is valued at a high price, it might be more beneficial and cheaper to raise cash through share issuance rather than through debt to boost the company's growth. As mentioned, the share issuance will dilute your earnings as shareholders, and I will now show you an example of how it will affect your returns. For this stock, I will estimate that the company will issue 2.5% of new stocks every year by taking the average increase over the last 3 years. You can find the increase in shares issued by the company in the balance sheet section of a stock on Yahoo Finance. Taking the same illustration shown in part 1 of the tutorial, I will now add one more column to calculate the adjusted future earnings per share of the stock after share issuance. The first step is to take 1.025 and multiply it 5 times, or calculate 1.025 to the power of 5, to get the increase in share caused by share issuance over 5 years. I will then get the number 1.13. In other words, the number of shares will increase by 13% over a 5 years period, based on the assumption of 2.5% share issuance per year. I will then take the estimated EPS in column 4 and divide it by 1.13 to get the estimated adjusted EPS in 5 years' time, which is in column 5. I will repeat what I did in the first part of the tutorial to calculate the stock price in the next column. And with this, you will be able to calculate the estimated gain on stock price over a 5-year period. You will notice that the expected gain has decreased due to share dilution. You will then have to re-evaluate if you are willing to buy the stock based on revised expected gain. And with this, I have finished going with you the 7F. I hope you have learned something in this video. When someone recommends you a stock, do not blindly follow what he says. You need to look through the 7F by yourself and decide if the stock meets your expected returns based on your own assumptions. Also, please remember my one last piece of advice for you. Dividend is not free. You should always do what I did in this video to calculate the number of years the company will take to repay the long-term debt after dividend, and see if you are comfortable with the stock after writing a story like what I did. Going forward, I will be making videos on stock analysis of individual stocks. I have listed some stocks on the screen. You can leave a comment down below which stock you would like me to analyze next. If you like my sharing so far, please click on the like button for this video and subscribe to the channel. I would really appreciate it. You can also support me on Patreon. The Patreon link is in the video description below. You can support my channel contents and research with just $3 a month. And with $8 a month, less than 50 cents a day, you can have access to my Discord channel and ask me any questions there. I will also suggest one stock every month. This stock is exclusive to my Patreons in Discord. The stock used in the illustrations in this video is this month's suggested stock. With just another extra $4 more, you will get a short report including a simple financial forecast from me regarding the suggested stock. The reason why I only suggest one stock a month is because I value quality over quantity. With that, I will end my video now. Remember to invest safely and logically. See you in my next video. Bye.